All right, good morning, everyone. Happy Tax Day, right? April 15th. That's a fun day. So, one piece of advice, remember this from individuals. If you're fielding any last minute panic people asking questions, I have. Meeting one this afternoon. You always have the escape hatch to file an extension, right? That just has to be done by the close of business day of the due date. You get an extension to file and prepare the tax return, you don't get an extension to pay. So if you think you might owe tax, you need to make an extension payment, or payment with your extension. But the filing an extension is extremely common. I do it every year. It's super easy. It's a half a page of paper. It's your Social Security number, and you don't even have to give a reason. Like I'm lazy. It doesn't matter. You don't give a reason. But you do have to pay if you think there's some reason you have to pay. But if you have somebody who's panicked and not getting the program they're working on or something, right? You can always say, hey, you don't have to do anything today. You can file an extension. But if you can't get it pushed through, then you're done and it's off your list, right? Okay, so we're gonna hopefully plow through most of tax treaties today. Most of the articles that we're going to talk about today. We left with definition of a resident. Remember, think of that as the gatekeeper. You don't get into applying a treaty unless you are a tax resident of the other treaty country to which you're trying to apply that treaty. So this is going to be very important because one of the more meaty topics we're going to talk about today is inappropriate access to a treaty and how the treaty partners try to police that and try to keep parties that aren't tax residents from availing of a treaty. But first thing you have to do before you start reading a treaty is just make sure that the party you're dealing with is a resident of that treaty. Okay? So there are tiebreaker rules provided in most tax treaties. So you can be a resident of multiple locations or multiple countries because each country has its own laws to determine who is a tax resident or not. That may be based on domicile, where they live. It could be based on residence, where their house is, citizenship and place of management, place of incorporation, or other criteria. So there's lots of different criteria that each country will decide how they're going to apply a certain tax. We know in the United States, right? Remember we started in half A, how we decided who was subject to U.S. tax. It's based on the person's residence, which means are you resident in the United States? If you're a corporation or you're organized under state corporate law, then you are automatically subject to U.S. tax. But that would get you to be the U.S. party. You can apply the treaty. You have to do the same exercise for the other party that's trying to apply the treaty of that particular country. Okay, so our first example is going to be a tiebreaker provision. 13.2, I don't think Claude is here. There we go. Go on down. So we're talking treaty, and we got to decide where this ZAPCO, what country it's in for purposes of applying what treaties. Okay.
So example 13.2, Hans, a citizen and resident of country F, which has a treaty with the United States similar to the Model Treaty, owns all the shares of ZAPCO, a corporation incorporated in Delaware. Hans is the president and CFO of ZAPCO, which he operates from a palatial office tower in country F. Under internal U.S. law, ZAPCO is resident in the United States due to its incorporation in one of the United States. Under internal country F law, ZAPCO is a resident of country F because ZAPCO's mine and management is headquartered in country F.
So when you hear mine and management, that's just where is the C-suite? Where are the decision makers for this organization? Where do they reside? Where do they live on a daily basis? Like where's their office? Where are the decisions made? So when you hear minded management, which is a very common criteria applied in the rest of the world, they will assert taxing jurisdiction over corporations that have minded management in the country. Okay? There's been a long-standing debate as to whether the U.S. should use a similar rule. The U.S. does not use a similar rule, right? Remember back to what we were talking about, displacement corporation or corporation. And so that can be vastly different than where your minded management sits, like this example. Okay?
Under the treaty tiebreaker rule, ZAPCO is a U.S. resident because of ZAPCO's incorporation in the United States.
So when you read Article 4 in the model treaty, there'll be a section that talks about if the taxpayer has multiple residences, then which one will control. And the model treaty says if there's multiple ones for a corporation, it's place of organization, place of incorporation. So we put this in the U.S., which means that now this ZAPCO is entitled to apply U.S. treaties with whatever country it's doing. That's the upshot of what this rule is trying to say. Okay?
Just to note, ZAPCO is considered a dual resident. That is, it's taxed in the U.S. by virtue of being formed under U.S. law and taxed in the country of its place of management.
Yes. So you see where ZAPCO is on the picture. It's on top of the wavy line between foreign and U.S. co. That's because it's subject to tax in the U.S. because it's formed under U.S. state law, but it's also subject to tax under country F because its minded management is in country F, the palatial office tower in country F. But for purposes of applying treaty, you have to apply one because you can't be in multiple treaties. So we're U.S. here, but it is ultimately subject to tax in 2 locations. Okay, so let's go to Article 5. Article 5 is permanent establishment. This is the same concept that we've talked about in the past. A central tax issue for any company beginning expansion plans into another country is whether such activity will trigger local income taxation. Like at what point do you become a local taxpayer? Okay? The PE provisions in tax treaties govern the level of activity a resident in one country needs to have in the other country before that other country can collect income tax from the taxpayer. This goes to one point I want to make. When you're reading these treaties, they can be very wordy, if you will. They use other country and home country and host country. I used to always, when I write these things down, I would just circle those and put what company they're talking about. So I knew who it was because it can get really chunky when you're reading it. But they're trying to cover, multiple things. So you just need to label the party that you're dealing with and where they are in those particular provisions. So this tells us what level of activity, at which point I do that or more, I'm subject to tax in the foreign country. So think of it as the negotiated position between the 2 countries, balancing the encouragement of international trade, which is what the countries are trying to do, right? Treaties are not trying to limit international trade. Treaties are trying to promote international trade by giving some level of certainty in this area. And we're also trying to protect the investment country's ability to collect tax on meaningful activity in its country, right? So it's a fine line. We're trying to have a threshold high enough to where we're allowing companies and people to do things from an international commerce perspective. We don't want to limit that activity, but it becomes a certain point when you're doing enough of it, you got to pitch in, right? You got to pay some tax to the local country because you were doing enough in that country that you should help pay for some of the upkeep of the society in that country. Okay. Note, remember the PE standard requires a relatively greater economic activity than that required in a non-treaty U.S. domestic law setting. So what the U.S., the PE treaty article has a higher level of activity you can do without you becoming subject to tax in the U.S. If you're in a non-treaty country with the United States and you're doing activity in the United States, that threshold at which you become a taxpayer is relatively lower compared to a treaty country. So remember I said Brazil was one of the jurisdictions that the U.S. does not have a treaty. If we have an inbound scenario where a Brazilian taxpayer is doing activities in the United States, we'll have a much lower threshold at which they become a U.S. taxpayer. if there were a treaty, they could do a little bit more without becoming subject to tax. And keep in mind, the PE provisions of tax treaties work both ways from a U.S. perspective, both inbound into the U.S. in that Brazil example I just gave, and also the outbound perspective if the U.S. is the one doing the investing in the other country. Just wondering at what level of activity do I become a taxpayer in that other non-U.S. country? Okay. In an outbound investment context, the business profits, so we're the business profits of a U.S. resident derived from activities in a foreign country are not subject to foreign tax unless they're attributable to a PE. So unless somebody says you have a PE and those profits are attributable to it, you do not have a U.S. taxable presence. There are two alternative tests under which a host treaty country can assert that the resident of another country has created a PE in its country. Fixed place of business, that's the bricks and mortar that we've talked about in the past, right? I have a physical presence in that country. That's going to make you taxable in that country on the profits attributable to that physical presence. And then I have the dependent sales agents test, which is I have a person in the country, so I don't have the bricks and mortar physical presence, but I have employees in that country, and those employees are dependent on me, meaning that they get paid by me, and they are contracting and binding me on contracts in that country. So those are the two tests in which we decide whether we have a permanent establishment or not. Okay, under the fixed place of business test, this is the article, this is what's written into the treaty. PE includes a place of management, a branch operation, an office, factory, workshop, or mine, well, quarry, other place of natural resource extraction. It's extremely very broad, right? So 13.4 is Sean. Oh, you were.
Forco manufactures widgets at its plant in Chicago, and since the plant is a fixed place of business, then Forco has a permanent establishment in the U.S.
And carry that on for me. Forco then has to file a tax return in the United States reporting the results from that manufacturing plant in the United States, right? And no, even we're going to talk about how the threshold next week. We're going to talk about how the thresholds are around the world are starting to come down again because of the changing in the economy over the last decade plus, where companies can now do business in another country without needing to have a physical presence as much as we had in the older economy. But you still have to meet that threshold, and at least in the United States, since this is an inbound perspective, so the U.S. is the host country here, the United States is not at the forefront of asserting taxing jurisdiction below the PE threshold in a treaty state. But certainly if you have bricks and mortar, you're going to be subject to tax in the United States. Okay, 13.3, Mayron.
In this example, USA Coal markets its products abroad by emailing potential foreign customers who then order online through the USA Coal website. And under the model treaty, the mere solicitation of orders through email does not constitute a permanent establishment. Therefore, USA Coal export profits are not subject to permanent tax.
So this is where there could be a level of dispute here. So this is an outbound investment, right? We have a U.S. Company that's investing or expanding abroad or soliciting abroad. So under the model treaty, which is really important in these facts here, this is not going to rise to the level of a permanent establishment. It's not bricks and mortar, and it's not a dependent agent. I don't have any of those two things involved here, so I do not, arguably under the model treaty, have a permanent establishment. But again, I put in the bubble here, the OECD-led effort known as Pillar 1, which we'll study more next week, is lowering those thresholds to where, for this very fact pattern, that USACO can derive a lot of business from the foreign jurisdiction here without setting foot from a physical premise perspective or a people perspective. And so the foreign countries are complaining, you're not paying for the cost of my jurisdiction that give rise to my customers being able to pay you for your product, right? So you need to pitch in. This is the whole Pillar 1 initiative. Pillar 1 is not advancing rapidly because of the difficulty. Sounds good in concept. I think we might all kind of agree. And then that it makes sense that USACO might have a tax filing responsibility, but the companies that are at issue here, it's largely your high-tech West Coast United States companies, and it's the United States government, because they're a party to this transaction as well, because if they start having more profits taxed in the foreign jurisdiction here, USACO is going to want to claim a foreign tax credit, which means the US collects less tax, right? They're effectively ceding some of their taxing assertion or taxing rights over USACO from historical standards to a potential new model where they're not taxing as much as they were. They're giving some of that to the foreign country. The devil is in the details on this. This is why the US is the biggest economy in the world. The companies that are affected here are the biggest companies in the United States. That's why it's advancing very, very slowly. They can't come to agreement on this. And it's hard for an initiative to take, especially a tax initiative, to move very far along without the U.S. being somewhat in support of it. Okay, okay, so I just want you to understand here that, yes, you can maybe hide behind Article 5 of the treaty for permanent establishment, but just realize foreign country here might have a different perspective of this. And this is where there can be just some disputes. And so the trade-off on Pillar 1, which we'll explore in more detail next week, is companies are coming at it saying, okay, we understand your issue. I might want to entertain paying more to your country, but then we have to stop the disputes. Okay? If I'm going to step over that line, then we have to agree that's as far as I'm going to step over. Don't be coming back and saying more and keep saying more and more and more. We have to have some delineation of how much I'm going to pay. That's where it's getting kind of bogged down. Okay. Okay. So the other part of Article 5 is the dependent sales agents test. And that's where a PE exists in a treaty resident when a treaty resident has employees or dependent agents in another treaty country, and those employees habitually exercise the authority to conclude contracts in that treaty country. So, authority to execute contracts is signing. Like, think of it as the agent and the principal. So the principal is the employer, the company. The agent is the person who's in the country. You are exercising the authority to conclude contracts when you sign as the agent on behalf of the principal. So when you sign, that binds the principal. Okay, that's concluding or executing contracts. And the word habitually needs to be routine. Doing it one time is not habitual, right? Doing it 5 times out of 10 times, is that habitual? It's starting to look more like it, right? So it's just got to be a regular occurrence that you have people in the country that are signing contracts on your behalf and binding you to that contract. Okay? The way I think about this and why this makes sense is because if that contract is executed in that other country, your remedy, if there's a dispute on that contract, is probably to the courts of that country in which you signed that contract. If you have access to their court system to mitigate a dispute or to resolve a dispute, I think most countries would say you need to pay something in the tax system to help support that system, right? If you're going to avail of our court system to resolve disputes, that costs money. Pay something into the till, into the treasury, to help support the system for which you can then access to resolve your business disputes. So, importantly, marketing products in another country solely through independent distributors or brokers does not create a PE in the other country, regardless of whether those parties conclude contracts in the company. So, if you decide to sell into another country, but you're going through independent distributors or brokers, and the key word here is independent. Okay? The independence must exist both in legal form and economically in fact. Okay, so in legal form, they're not your sole aid, you're not the sole principal for them, meaning that they have lots of customers. An independent distributor has typically many customers, right, not one. And economically, in fact, means they may have multiple customers, but you can't be 98% of their business, right? Because then economically, they know they work for you, right? So it has to be dispersed in numbers and dispersed in economic reliance. That will make the independent party not pull you into the country from a tax perspective, even if they sign contracts on your behalf. Okay, 13.7. You may want 13.7.
A corporation incorporated in country F employs a U.S. citizen and resident that spends 3 months a year traveling throughout the United States and soliciting purchase orders from U.S. customers. Although the sales employee solicits customers and has customers sign purchase orders, the sales employee does not sign purchase orders. Instead, the sales employee forwards the purchase orders to Forco's home office in Europe for final approval and signature. Under the appropriate tax treaty, Forco would not incur U.S. tax for Forco would incur U.S. tax as Forco will not have a permanent establishment in the United States due to the sales employee lacking final contracting authority. However, if the sales employee has the authority to enter into contracts without the approval of Forco's home office and the sales employee regularly exercises that authority, Forco would have permanent establishment in the United States and therefore incur U.S. tax.
Yep, so we have somebody in country, in the United States, on an inbound solicitation. If they have the authority to conclude contracts and they habitually exercise that, that will pull Forco into becoming a U.S. taxpayer. Now, you can try to put up guardrails or parameters that won't happen. That, as they say at the top part here, the person does not sign the purchase orders that's in the United States. They send it back to the home office. I would add for not just final approval and signature, but for vetting. Vetting, like, are these terms that you negotiated compliant with our requirements, right? Each country, or each company has their requirements for how they do business, their wish list. Are you deviating from them? So we're going to try to make changes to it, then we approve it, then we sign it. Where I think that helps, that certainly helps providing those guardrails if you have policies. But the proof is in the pudding. Another analogy, meaning that what actually happens, right? You can have a policy where you cannot conclude contracts in the United States. They have to go back to the home office for vetting, approval, and signature. But are you actually doing that, right? The policy doesn't mean anything. What is factually happening? Is your salespeople actually doing that? And then the other question you have is that process, sending it back to the foreign home office, is that a perfunctory effort? Like, they never make a change, they never ask a question, it just comes through, they sign it and send it back. That would make, if that happened 100 times out of 100, I would say that's just, the substantive work was really done in the United States. There was really no vetting that happened in the foreign home office. And so that would put pressure on your policy, is that really effective? Certainly have your policy if this is what you're trying to do to prevent becoming a U.S. taxpayer, but then make sure your salespeople are doing it and make sure there's some real meaningful review. The other thing I mentioned in this setting before, don't let the tax tail wag the dog. If you're getting more business because your superstar salesperson is out there signing these contracts, don't be afraid to become a U.S. taxpayer. At most, you lose 21% of your profit attributable to that activity. But if he or she grows the pie twice as large because they're out there selling more work because they sit across and have a great meeting, we're executing this contract right now, and I'm going to go this afternoon and execute one down the street. Do that. Don't be afraid to become a taxpayer. Okay. Okay, so moving down the treaty. Article 7, this is business profit. So if a foreign resident has a PE in the United States under either one of those prongs, fixed place of business or dependent agency, the U.S. may tax the business profits of the resident, but only to the extent those business profits are attributable to the PE, right? In this example, if we're down here at the bottom, so the sales employee does have the authority and executes it, so we do have a taxable present. That doesn't mean all of Forco's business is taxable in the United States. It's only the portion that is attributable to this activity, right? Now that's where it can be a little dicey as to, well, how do you carve off that portion that is attributable to the PE? So that's based on the fiction that the PE is a distinct and independent enterprise dealing at arm's length with the owner of the PE. So we have to fictionalize, well, what if this was a separate and distinct business? Almost think of it as, like, we're going to take this section here of Forco that's attributable to the U.S. business, and we're going to put a box around it, hypothetically. That's going to be what goes on the U.S. tax return. Forco would file an 1120F. That's the form 1120 for what we're studied in taxation of business entities. The F just means that's a foreign corporation filing, but it looks exactly the same. Income, expenses, taxable income. That's what you're going to capture, but only for this piece, right? That's the business profits. Keep in mind, if the PE performs more functions and assumes greater risk, the foreign person should attribute more income to the PE, right? My hypothetical, if it's a superstar salesperson out there, maybe you need to put more profit because that activity is going on in the United States. If really it's the product that's driving the value, then maybe more of that belongs in Forco because maybe they're the one manufacturing the product, right? So each fact pattern is going to be different. Like, where are the functions and risk within the supply chain? If the more there is in the U.S., you should see more profit. The less there is in the United States, the less profit. So again, if you have somebody executing contracts in the United States, pulls you into a PE, try to limit the amount of profit you attribute to that PE. That's another way to manage your U.S. tax liability. In calculating those business profits, a taxpayer can allocate all direct costs. So if it's a buy-sell, so if you're selling into the U.S., you can do cost of goods sold, right? That's a direct cost. You're not taxing your gross revenue. And you can make reasonable allocations of indirect expenses. Your SG&A, your R&D, your interest expense, those types of things. Because you're computing that 1120F, right? It's got income and it's got expenses. You get to take expenses against that. But you're doing a fictional computation because there is not a separate legal entity. Okay, so you got to kind of like carve off a portion of that foreign company's results and attribute them to the U.S. Okay, shifting to Article 14. This is personal services income. Okay, so this is the person coming to the United States, and there are person from the United States going into the other country. When does that person become subject to tax, individual tax in that country? So, as a general rule, when an employee who is resident of a treaty country, meaning they're a taxpayer in that other country, derives income from services performed in the United States, we have an inbound setting, the U.S. subjects that individual to income taxation. So, as a general matter, we're going to look, if you are doing services in the United States and you're being paid for it, you're a U.S. taxpayer. However, there is an exception if the employee is present in the U.S. for 183 days or less, half the year, assuming the employee's compensation is the responsibility of the non-U.S. employer. If you have a U.S. branch, then you're going to be outside this rule if that U.S. branch is the one paying that individual. Tax treaties usually contain special rules for certain types of personal services income. Those derived by crew members of ships and aircraft, right, because those are very transitory as they come through, so they're not going to be in the United States for 183 days, extended period of time. Board of Directors fees, so Board of Directors as well. The reason that's a special rule is because you might have a physical board meeting just maybe once or twice a year, but usually those director fees are pretty large. Say the director gets $50,000 for a board meeting. But that experience that they bring to the board meeting, you don't want all of that income being subject to tax on that one meeting, right? Some of that's brought from afar. So special rules there. Entertainers, athletes, right, outsized contracts. You're not in the United States for 183 days. If, one of the European soccer teams comes over here in the United States, they might be here for 2 weeks, having a handful of matches, but they have very large incomes that you'll see. Entertainers as well, concert tours, those types of things. Special rules for that. So just keep in mind, so government workers as well. We obviously have a large contingent of non-US people in the United States representing their governments. There are rules around that as well. So special rules here, but the general rule is you're taxable if you do services in the United States. We have a treaty rule. If you're 183 days or less, you're not subject to tax. 13.8 is open. Anybody?
FOCO is a corporation organized in country F, which has a treaty with the United States that is similar to the Model Treaty. FOCO is in the refrigeration business. Due to the high demand for air conditioning repair services in the United States in June, July, and August, FOCO sends Norman Ray Allen, NRA, citizen and resident of country F, to service customers in numerous U.S. locations. During that time, NRA helps repair air conditioning for many different customers of FOCO. The compensation that FOCO pays NRA is $20,000.
So NRA, the authors are being cute. NRA stands for non-resident alien. Non-resident means they don't live here in the United States, and alien is, no offense, it's just a historical tax language talking about an international person. So non-resident alien, so we have a non-resident international person coming to the United States, doing some activities for some period of time and get paid for doing it. Okay.
NRA does not pay U.S. tax on its $20,000 of compensation for services it performs in the United States pursuant to the applicable treaty because 1. NRA is in the United States for less than 183 days. 2. NRA receives compensation from FOCO, which is not a resident of the United States. And 3. NRA's compensation is not borne by a permanent establishment that FOCO has in the United States.
So here, and again, this is trying to keep this individual from not paying tax in the United States. They will certainly pay tax if they're in the country of FOCO, which is most likely the fact that they will pay tax in that country on all of their income, right? Because they're a taxpayer there. But here, because they abided by the treaty threshold, which is 183 days or less, they won't pay tax on this. And so if this person stayed here for 3 more months, then they 4 months, I guess, 3 months plus, they would then be subject to U.S. tax on that. Okay, so those are kind of the core upper level articles when you first get into the treaty. And it's all talking about residency and at what point either a company in one country becomes taxable in the other country or one individual becomes taxable in another country. Now we're going to shift to the sections, the articles in the treaty that deal with withholding tax. And these are the passive flows of income that go both ways. It's not just U.S. withholding tax, it's U.K. withholding tax coming to the United States, Chinese withholding tax coming to the United States. So it flows going back and forth and by type of income. Okay, so each article has its own, or each type of income has its own article. Most countries impose a flat rate of withholding tax. It's 30% in the United States on dividends, interest, and royalty income earned by non-residents from sources within their country. So under U.S. domestic law, we say 30% is the general rule. That's a hefty withholding tax. domestic law in another country for a payment coming out of their country to the United States, maybe 30%, maybe less. You'd have to look at each country. That's why there's no one's an expert on worldwide tax, 'cause international tax, you can't know the laws of every country. However, most tax treaties provide for reduced withholding tax rates on dividends, interest, and royalty payments to residents of treaty countries. Okay, so one of the advantages of a tax treaty and entering into the negotiation of it and the execution of a tax treaty is the lowering of withholding taxes. Right? Think about when we started the original discussion, the pie. You get to keep more of the pie because you have less withholding tax. That's generally a good thing. I think this goes to the spirit of tax treaties, which is wanting to incentivize cross-border investment and activity, right? We want to invest in the UK. We certainly want UK residents to invest in the United States, and same goes for the rest of the world. Okay? So for the dividend withholding, that's Article 10. So in the case of dividends, the withholding tax rate is often lower for controlling shareholders, which are 10% ownership by a corporation under the U.S. Model Treaty, than for non-controlling shareholders. And I think that's probably just due to the controlled nature and having a large stake in a company. If you own greater than 10%, a material stake as opposed to a passive stock investment that you may have. Some treaties even reduce the withholding rate on dividends to 0 in certain instances. So here you can see just certain countries in this table. So you just take Canada because that's very common. So controlling shareholders get hit with a 5% withholding tax, and non-controlling shareholders are higher at 15%. So that goes for if the U.S. is paying, if you have a U.S. corporation paying a dividend to a Canadian shareholder, if that's a controlling corporation, 5% gets withheld and remitted to the U.S. government. If it's just to a Canadian individual who does, who's just the investor, that's 15% gets withheld. The same thing happens if you got a Canadian corporation paying a dividend to a U.S. investor. 5% if you're controlling, 15%. So they're reciprocal. That's why when you read them, it says treaty, country, or non-treaty resident. And you have to label which one is your taxpayer, which direction they're going. You see here in China, the same rate, 10% for controlling or non-controlling. That's where you have to go into each specific treaty. What was negotiated between the parties as to the rate. So the model treaty just gives you a general starting point, but this is one area where the countries negotiate. And one of the reasons why you have negotiation is because there might be a skewed volume of investment one way versus the other way. One thing I have found and heard my Canadian colleagues say quite a bit is there's much more investment from the United States into Canada in volume compared to Canadian into the U.S. Certainly sizable Canadian into the U.S. investment, but it pales in comparison to the outbound investment from the United States. So that's where if we set a withholding tax rate, given it's reciprocal, it might affect one country more than the other because there's more. Canada's saying I can't go to 0 because I got so many outbound dividends going to my U.S. investors. I need to collect something on that so they don't go to 0. They'll say at 5. You will see some countries like the UK, you can get down to 0. So my experience has been countries where we have a long-standing relationship with, you'll see lower withholding rates. I think that's just partly because the friendliness of the countries, and when they start negotiating these things, they can agree to much lower withholding tax rates. Okay, let's do 13.9. You may want 13.9.
So USACO is 40% by Forco, which is a corporation incorporated in Country F, and 40% by Norma Ray Allen, which is a citizen and resident of Country F, and 20% by Clon, which is a citizen and resident of Hong Kong. And Country F has a treaty with the U.S. that is similar to the Model Treaty, and Hong Kong does not have a tax treaty with the U.S. When USACO pays dividends to its shareholders, USACO will withhold 5% of the dividends paid to Forco because Forco is a controlling company pursuant to the treaty, and 15% to NRA because NRA is an individual resident of a treaty country, and the statutory rate of 30% to Con because he is not a resident of a treaty.
Yeah, so this is what makes it a challenge for USACO. Let's say it's a publicly traded company. Say it's Apple. They got investors, huge amount of investors in the United States, and they have non-US investors, right? You have to know the identity of each investor. And we'll talk about the reporting a little bit later, but you need to get information from them. Tell me who you are. I don't know who you are. But USACO, in my hypothetical, Apple is the withholding agent. Remember what we said, the withholding agent, the reason the government gets their attention, because if you don't withhold the right amount, you're liable. The government doesn't have to go and chase all the shareholders. They'll just say, Apple, you owe me money. So the two things I put in the box over here, you need to determine whether each shareholder is a resident of a tax treaty country. So Forco is going to say, oh, hey, I'm Country F Corporation. Well, how do I know that you pay tax in Country F? Here's my tax identification number that I pay tax in Country F. NRA, I'm Country F individual. How do I know that? You need to provide evidence to me on that. Kong is Hong Kong. They're not trying to assert a treaty, so it doesn't get any worse than 30, right? The USACO is not going to get in trouble for withholding 30 because the government can never collect more than 30. Okay, so you need to know whether a treaty is being applied or not, and then number two, if a treaty is applicable, then is there any corporate shareholder with what's their ownership percentage, which is the reason why Forco gets 5% compared to NRA, who's also a tax resident of Country F, gets 15 because they own 40%. So Apple would probably know that. They would know that they could get information on that. So that's just the mechanism you have to do. And so you can see how this could be a very cumbersome process. Usually, I think banks, the big banks help companies deal with this because it's a compliance nightmare to gather all this information. If you're paying quarterly dividends, you're doing this 4 times a year. It can be kind of a messy situation. But you have to take it seriously because the government puts the onus on the withholding agent because they don't want the hassle of having to chase everybody. Right? They can just go straight to the withholding agent. So you did the right of withholding tax. Okay. In the case of interest, withholding tax rates of 10% or less is common in tax treaties. Again, remember the U.S. can start at 30, but we can drop down. So look at all these zeros. We pay Canada, either way, Canada paying us interest or U.S. paying Canada interest at 0, Finland 0, France, Germany, Ireland 0, Netherlands, UK. And the Western Central Europe at 0%. I think the reason why you see 0 so often on interest is because the interest income is taxable to the other countries, right? Dividend income is typically not taxable in non-US countries because they apply the territorial regime, which is money earned outside their country. But interest from being a creditor and advancing money to someone is taxable income everywhere in the world that I'm familiar with. So I think there's a recognition that when I'm paying interest, the other side of the transaction is fully taxing the interest income, so I don't need to withhold on that. So that's why you see zeros a lot on interest. Okay, 1310 is Kate.
This example, Forco, a corporation organized in Country F, Norman Ray Allen, a citizen and resident of Country F, and Khan, a citizen and resident of Hong Kong, loan money to USACO. Country F has a treaty with the United States that is similar to the Model Treaty. Pursuant to the Model Treaty, the interest paid by USACO to Forco and NRA is exempt from tax. However, since Khan is a resident of Hong Kong, a non-treaty country, USACO must withhold the statutory rate of 30% from the interest.
So this is a similar fact pattern to the example Matthew went through, except it's not an equity relationship, right? It's a lending relationship. And so you see here the controlling or non-controlling is a non-issue, right? Because the creditor doesn't control the borrower. So both Country F tax residents get 0 because the treaty is flat zero to that country. And Hong Kong still gets hit with the 30% because there's no treaty with Hong Kong. Remember, Hong Kong for treaty purposes is treated as not being China. Okay, last withholding, royalty. In the case of royalties, withholding tax rates of 10% or less are common, so just like interest, but they vary based on the type of royalty, i.e. which depends on the underlying intellectual property, the license of which gives rise to the royalty. So this one can be somewhat challenging, is understanding what type of royalty do you have. You have to get somewhat granular, have the company explain to you, because usually it's a bundle or a collection of rights that are being licensed, so you have to categorize it first, and then read the treaty and see what rate of withholding they put on that. So again, we see our usual suspects of treaty partners here. You see patents, film and TV, and copyrights, and know-how, and other, and you have different rates across those types of royalties. And so the challenge here is just getting granular again and rolling up your sleeves and understanding what is being licensed, and make sure you're reading the treaty correctly. But you see a lot of zeros in here as well. I think, again, similar premise as to why we have a 0% withholding tax rate, because royalty income is taxable. The IP resides in the other country, that's why they have the ability to license it. So I think the premise that it being taxable leads a lot of treaty negotiations to get down to 0. Okay. 1312 is marriage. Well, let me premise this so we're not doing royalties. So this is disposition of property. Okay, so we're moving on to passive income flows. Now I'm selling a piece of property. Gains from the disposition of property, such as capital gains on the sale of shares and other securities, generally are only taxable by the country in which the seller resides. That's our seller's residence rule. That's certainly the U.S.'s perspective. We don't tax capital gains for sellers outside of our country.
In this example, Bridge Rock is a foreign corporation organized in country F, which has a tax treaty with the United States that is similar to the model treaty. Bridge Rock owns all the shares of its U.S. subsidiary, Fire Rock, and when Bridge Rock sells the Fire Rock shares to a purchaser, the treaty does not permit the United States to tax the gain. This is similar to the result in example 9.1 under the
Yeah, and I would just argue that it's not even U.S. source, so I don't even really need to go to the treaty. So if I have Bridge Rock, foreign seller selling stock of a U.S. company, I can only tax income that has a U.S. source. And remember way back in half A, I think it was chapter 3, we did sourcing. We had all those rules by type of income. The sale of personal property, which is what this is, because stock and securities is personal property. Remember, real property is land and things permanently attached to it. Everything else is personal. I would source that to the seller's residence, and that's foreign in the sense that I don't have the right to tax this. So I view this article as just embedding that rule in the tax treaty, but I do not tax this income, and so I just don't tax that. Now, remember, we have an exception to the seller's residence sourcing rule back in that Chapter 3 material, where sales of shares of a U.S. company whose value is principally comprised of U.S. real estate. Remember those examples we did at the start of half A? If this company had 50% of its assets derived from U.S. real property, then we equate that to the sale of U.S. real property. And we do tax that. We treat that as U.S. source income. Finite resource. Okay, and that's this example. So given the special nature of real property, it is difficult to create more, right? Finite resource. Most countries retain their right to tax non-resident sellers of real property located in their country. 1313 is Eugene. 113.
Uncle Sam, who's a U.S. citizen and resident, owns appreciated real estate in Country F, which has a tax treaty with the United States that is similar to the model treaty. Uncle Sam sells this appreciated real estate for substantial gain, and Country F can tax that gain. And if it does, Uncle Sam may claim that credit against his U.S. tax liability for the Country F income.
So this is outbound investment from the United States into foreign real estate. If I do a transaction where I dispose of that foreign real estate at a gain, that foreign country can tax that. Or if I flip that around, the mirror side of that is foreign investment in the United States on real estate. Remember I talked about Rockefeller Plaza, the instance in time when there was Japanese ownership over that asset. That gave rise to the FIRPTA rules. Remember, Foreign Investment in Real Property Tax Act, FIRPTA? That's where the U.S. says we're going to tax those gains. They've embedded that concept in the model treaty. It's all premised that real estate's special. We're going to allow the country that where the real estate resides to be able to tax. Okay, so moving on, we're going to go to some other parts of the treaty. So there's relief from double taxation. So remember, one of the reasons for the treaty is to encourage activity, but one of the ways we do that is we want to try to make sure there's some relief for the double taxation of the single item of income, right? Because that's going to be a discouragement to foreign investment. So a primary goal is the mitigation of double taxation. As we've discussed, the U.S. and most of the remainder of the world mitigate exposure differently. Mitigate this exposure to double taxation. We know in the United States, we do that via the foreign tax credit, right? We tax our U.S. residents, which if it's an individual, we tax them on their worldwide income. If it's a U.S. corporation, we tax them on their worldwide income. We understand that some of that worldwide income might be taxed in a foreign country. We alleviate that tax that they incur there in the United States by providing a foreign tax credit against their U.S. tax liability. We went through numerous examples of that, right? In the non-U.S. method is typically a territorial or an exemption method, right? They just don't tax the activity outside their country that's just not in their taxing jurisdiction under their domestic law. So very clean from their perspective. We do have relatively rare instances where non-U.S. countries impose an FTC. My experience has been it's Mexico and China have similar rules to the United States, but the rest of the world just doesn't tax things that happen outside the country, so they're very clean from the mitigation of double taxation. So that's embedded in Article 23, where the treaty partners have agreed to mitigate double taxation of the same item. All right, so this is a pretty meaty section here. So all the things we talked about are advantageous to business, right? I have clearer rules on what I can do within a country before I become a taxpayer in that country. I have lower withholding taxes if I'm in a treaty. But what if I'm an investor and I'm coming from a non-treaty residency perspective? Okay? I might try to inappropriately route my investment into a treaty partner through another treaty country. Think of it as a third wheel, an intermediary that doesn't belong in the transaction. And I'm doing that to avail of these favorable treaty benefits. Clearly, the treaty partners do not want that, right? I'm only willing to give a lower withholding tax because I entered into this treaty with that country. And it's dependent on all other parts of that treaty that we negotiate. I don't want some other party coming in and interposing just for one particular part of that, right? Their country of residence, I did not negotiate a treaty. I need to protect the treaty from that type of inappropriate access. Okay? So, a multinational corporation, or a multinational corporation might have more flexibility to how they structure and route their investment into a country. And they may be tempted to try to do something to lower their global tax, as we would but do so via the access of treaties. So the limitation on benefits article, that's what's the legal term. So when you read the treaty, it'll say limitation on benefits, and that'll be in the Article 22, or closely in that neighborhood, Article 22 of the model treaty. But it's also called anti-treaty shopping. Okay, treaty shopping meaning that's the very problem I just mentioned. You're trying to route your investment. You go out there, you're shopping for treaties. Right? I'm going to make my investment through that vehicle to access that treaty. In the eyes of the treaty partners, that's inappropriate. Therefore, they do anti-treaty shopping provisions to prevent that behavior. Okay? So let's do 13, 15. Yes, Connor.
So for this one, USACO is a US corporation with a subsidiary in County X. The treaty between the United States and X provides 15% withholding rate for dividends paid to a controlling shareholder.
So let's hone in on that. So that's the picture on the left. Dividends coming out of subsidiary X to the USACO is hit with a 15% withholding tax in country X. That means $100 dividend, USACO only gets 85. 15 gets sent to the country X government. Now, if I can claim a full foreign tax credit for that, then I'm sort of indifferent, right? Because I pay less US tax on the dividend because I get a foreign tax credit, but I've effectively paid that to the country X. But I've still paid the 15%, but I only paid it once. But what if USACO can't claim a full credit? Remember we have to do an FTC limitation? What if there's some noise in that limitation that I can't claim a credit? That's where USACO could say, now I'm having double taxation on that dividend income. That would lead them to trying to do something on their right. Right? That's why they might want to try to lower the withholding tax.
In contrast, the withholding rate on dividends paid to controlling shareholders 5% under the treaty between the United States and country Z, 0% under the treaty between country Z and X. Furthermore, country Z exempts foreign dividends from Z's income tax. Therefore, USACO may be able to reduce withholding tax rate on earnings repatriated from its country X subsidiary from 15% to 5% by interposing a Z holding company between itself and the X subsidiary.
Yeah, so I put over there to the right up at the top here, such planning is indicative of treaty shopping, right? You're shopping around, you're looking, oh, country Z has a nice 0% coming out of country X and only 5% coming into the United States. So I could lop off 10% off my withholding tax burden, and importantly, country Z does not tax dividend income, right? That's right, territorial. So therefore, I'm not layering on any more tax, so I got a potential withholding tax reduction of 10. If I put that through my FTC limitation calculation, maybe I have sufficient room to utilize the 5% withholding tax, and therefore that's much better than the left-hand side of this. Now, the LOB, people call these LOBs, that's the limitation on benefits. The LOB provision of the the tax treaty between country X and Z would probably put this withholding tax rate at 15%. Because country X is going to say, should I apply the XZ tax treaty? And when we go through the tests that they would have to determine whether they met the LOB provision, it would probably say no, and they would then look to the owner and go back to the 15%, which is what the left-hand side of this. That's the guardrails that the LOB provision does. Is it tries to smoke out the intermediary that's put there solely for treaty shopping purposes. Okay? Perfect. Thank you. So when it says potential and may, that's because if you didn't have these provisions and you could just insert any country in there, the whole tax treaty system would just fall down, right? If you could just go out there and just interpose anything you want that had a lower tax burden, and that's not the purpose of tax treaties, right? They're trying to limit it to real tax residents. Okay? Okay, let's do one more. So this is 1316. Anybody want 1316? Oh, no. So this is the same, similar thing that Connor went through, but this is inbound. So now we got Forco coming into the United States.
Forco is a country B corporation with a subsidiary in the United States. Country B does not have a tax treaty with the United States. Accordingly, the U.S. withholding tax rate on any dividends received by Forco from its U.S. subsidiary is 30%.
So let me pause you there. So that means that from a Forco perspective, their investment in the U.S. sub, when a $100 dividend is paid by U.S. sub, they only get $70. $30 goes to the U.S. government, right? That's pretty drastic, especially if Forco is like most of the rest of the world and they don't tax dividends for earnings outside their country. Therefore, they're only getting 70% of the pie, not 30, not something greater than that. So this might lead them to the facts you're going to read next, right?
In contrast, the withholding tax rate on dividends is 0% under the treaty between the United States and country C, and 10% under the treaty between country C and D. Furthermore, country C exempts foreign dividends from C's income tax.
So again, that's facts like that. Someone is treaty shopping, right? They're looking around, they're quote interviewing other countries to see how much lower they get their tax. And C makes the list here because I got 0 coming out of the U.S. to C under that treaty, and C, the country doesn't tax the dividend income, so I don't layer on any tax there. And then having to get the money from C to B, that's only a 10% cost. So arguably, I lop off 20% of the withholding tax, pushing my share of the pie from 70% to 90%. That seems great, right? Why wouldn't I do that?
Therefore, Forco may be able to reduce the withholding tax rate of dividend distributions from its United States subsidiary from 30% to 10% by interposing a country C holding company between itself and the U.S. subsidiary.
Yep, so I put in the box here, the LOB provision that would be applicable is between the U.S. and country C, and that would likely result in U.S. withholding of 30%. Because you're going to see how the LOB provisions work. They would not apply the U.S. country C treaty, and then instead look to country B and say no treaty, 30%. Gets back to the left-hand side. Okay, great, thank you. Okay, so I talked about the treaties refer to anti-treaty shopping provisions more formally as the limitation on benefits. In practice, everybody calls these LOB provisions. The LOB provisions have been introduced in the tax treaties principally by the United States. The United States was the one who wants to make sure that we police these inappropriate access to treaties. It's caught on to the rest of the world. They all like it as well. I'm going to go through a very recent example for India where they took a similar view of a transaction. So in order to avail of the treaty provision, so whenever I'm trying to apply the treaty, first I got to determine, are you resident? In both of those examples that we went through, they're going to be able to show that they're resident. Because holding company in country C on the right side, the intermediate company here, is probably subject to tax in country C. It just doesn't have any activity in country C. It's a brand new entity. I don't have any activities in it. I don't have any employees. All it does is own stock. So if I was only held to that first gateway question that we started today with are you resident, then I couldn't do anything. I also have to meet the LOB provision in Article 22 to make sure that you're not a resident that's solely there for treaty purposes. Okay? The main target of LOB provisions is the interposing of a treaty corporation merely to avail of that country's tax treaty. In such instances, the application of the LOB provision will frustrate the application of the desired treaty. So that's where I was saying. In both of those examples, we would not respect the holding company and we'd get back to the left-hand side of this. Always looking for something that's interposed. Why is that there? That's what the LOB provisions are doing. Okay, so the LOB provisions are not subjective, they're objective. And this is one of the aspects of a treaty, right? A treaty is supposed to provide some certainty to cross-border investments. So if we have a lot of subjective criteria, that does not lend itself to very conducive to business certainty that we would want. So we have objective criteria. Okay, so we're gonna go through each one of these because I think they're very intuitive, and I want to go through them because they're very important. This is the hottest stuff going in tax treaties right now. So, if you meet one of the following fact patterns, you're going to be okay under the LOB provisions, which means that we will apply the treaty that you're trying to apply. So, the interposed corporation's shares trade publicly. The interposed corporation is a subsidiary of a publicly traded corporation. The interposed corporation meets both a stock ownership test and a base erosion test. The interposed corporation earns income that is related to an active trade or business. The interposed corporation satisfies the derivative benefits test. When I was first came across these issues in practice, I would get confused by all these, but I think if you think of the rationale, they make sense. Right? There's a reason why you would have, if you meet one of these tests, that you would have allow treaty benefits to flow. Okay, so the interposed corporation's shares trade publicly. So in that interposed company in those examples we just went through is entitled to treaty benefits if both its principal class of shares trade publicly on a recognized stock exchange and in its country of residence, either the recognized stock exchange exists or the company's management control exists. The rationale here, if I interpose a company and I get a better treaty result, but I publicly list that interposed company, there is so much more that is going on than treaty withholding tax rate reductions, right? Because that's not something any company is going to do easily, right? You don't just publicly list. That's costly. It has requirements, there's regulatory requirements, all those things. So it's indicative of a non-treaty shopping purpose, right? That you're not just doing this to avail of the treaty. If you're willing to go to those lengths, that's indicative that you didn't do that for solely to apply a treaty. Okay, let's do that. Example 1317 is Sean.
Foreign Publico is a country F corporation whose principal class of shares regularly trade on a recognized stock exchange in country F, which has a tax treaty with the United States, similar to the model treaty. Foreign Publico, which is a resident of country F, owns all of the shares of US Sub, and US Sub pays a dividend to Foreign Publico. Because Foreign Publico's shares primarily and regularly trade on a recognized stock exchange in country F, the dividend Foreign Publico receives from US Sub incurs withholding only at the 5% tax treaty.
So Foreign Publico is a tax resident of country F, wants to apply the treaty to lower withholding tax rate on dividends from the United States from 30 to 5 under the treaty. You get to the LOB provision, if you look at the recipient and it's publicly traded, you're done. There is no treaty shopping in the objective eyes of the treaty negotiators, because who is going to invest through a public company, right? Because there's so much more business conditions and headaches going on for Publico to be publicly traded. It's not indicative that the investors up here were solely routing their investments into the United States through a interposed country F corporation, right? I think that makes perfect sense, right? We're just gonna piggyback off the fact that there's so much going on when you decide to publicly list that that's indicative of a non-treaty shopping purpose. Okay? The second test is the interposed corporation is a subsidiary of a publicly traded corporation. So an interposed corporation is entitled to treaty benefits if over 50% of its shares are owned by 5 or fewer corporations that are entitled to treaty benefits. The rationale here, in my mind, is the indirect owners, which is the owners of the interposed entity, the intermediate entity, would have otherwise enjoyed treaty benefits if they held the shares directly. Then interposing a corporation is unlikely to have been implemented for treaty shopping purposes, right? Why am I treaty shopping if I already could have got a good treaty rate? Indicative of something else going on as to why something non-treaty shopping related is going on by interposing that entity. So 1318. Anybody want 1318? I'll do 13. So here, I have my same foreign publico. In the prior example, by interpose a foreign subsidiary. Okay? So that foreign publico is a resident in country F, owns all the shares of Forco, a country F operating company. So when I looked at it, it's trying to apply the U.S. country F tax treaty because that's the direct recipient of the dividend. And so I'm going to get a tax residency position for sub because it's a country F corporation. But because foreign publico shares are primarily and regularly traded on a recognized stock exchange in foreign country F, and foreign publico owns all the shares of foreign sub, then I would, if this investment was done directly, I would have been in the prior example, I would have got 5% withholding tax. So what they're saying here is, just because I interpose an entity, I should still get the 5%. Because it's still the same country with the foreign public company in there. Meaning that you don't treaty shop if you're already in a good position. Right? Treaty shopping is when you're getting in a better position. Nobody tries to do tax planning to get in the same position. Okay. That's interposed corporation as a subsidiary of a publicly traded corporation. Okay. The interposed corporation meets both a stock ownership test and a base erosion test. So this is very similar to number 2, but with an added feature to it. So an interposed corporation is entitled to treaty benefits under this test if at least 50% of its stock is owned by residents who are entitled to treaty benefits. So again, I'm looking up and saying, well, the owners would have already gotten treaty benefits if they would have invested directly. But here I have in less than 50% of the interposed corporation's gross income is offset by deductible payments to persons who are not residents of either treaty country. This is the base erosion test. Okay? So what they're saying here is, what if somebody was clever and said, oh, I see these 2 tests you have, so I'll make an investment with an interposed corporation, but I will make the investment via a loan to the interposed corporation, so I base erode, I divert the income out of there with a deductible payment. If I do that and you don't have this rule, then whoever is that lender that wouldn't have been entitled to treaty benefits maybe gets their income out of the United States without withholding taxes. Okay? So you can think about these things as shutting down potential planning avenues that people would have that are creative, trying to avail of treaties. So that's the rationale here. I just don't want to see an interposed corporation that otherwise meet the first 2 tests, but then it's paying significant base erosion payments. So I'll do this example. So this example is, I have Forco, and Forco is country F again. And Forco has 2 investors. I have a country F investor, and I have non-resident alien who, and the 50-50 owners. So each own 50% of Forco, corporation organized in country F. Forco earns approximately $50,000 of gross income and pays a salary to NRA of $20,000. So that's our base erosion payment. Okay? So I pay $20,000 of the $50,000 of gross income out to non-resident alien because Frank owns at least 50% of the shares and less than 50% of Forco's gross income results in deductible payments to non-resident treaty partners. Then Forco receives treaty benefits as a result that 5% applies. So what we're saying here is this dividend, I want to apply Forco because it's country F. And I can do that so long as I have sufficient ownership that F has, because F is an individual who would have been able to get the 5% if it went directly, and I'm not inappropriately base eroding out to non-resident parties. Again, I think that intuitively makes sense. I should apply treaty benefits here. And you're just looking for somebody being cute there and base eroding your intermediary. Okay. I put in the bubble here. The non-treaty U.S. domestic withholding tax would have been 30%, would have applied if Frank owned less than 50%. These are objective tests. so it's 50% or more, or NRA received a salary of at least 25, because then I would have exceeded the base erosion payments of 50% to a non-treaty partner. Okay. The interposed corporation earns income that is related to an active business. Okay. An interposed corporation is entitled to treaty benefits if it is engaged in an active business in its resident country. This only extends to income that emanates from or is incidental to that business, and only if the business of the interposed corporation is substantial in relation to the activities of the U.S. business. So this is, again, we're looking at the interposed company, a material operating company is the way I think about it, that receives an income stream is connected to the aggregate business, so connected in some fashion to the U.S. business. Same division, same type of product, something that is factually connected between the two is a rationale beyond simple treaty shopping. So 1320, we have the same, we have Forco here, and we want to apply the country F tax treaty. It's a tax resident, but now we have to consider the LOB provision. If country F is in an active business that relates materially to the U.S. Co's business, then I can apply the treaty that the U.S. has with country F. Here the fact patterns are Forco makes $100,000 of business income. I look to the U.S. and it makes $10 billion of business income. Those facts are kind of smelly. It doesn't mean that that's a real material business, right? And so you need to have a substantial active business in your company if you're trying to meet the LOB provision here. Now you don't need to do this if you're publicly traded, right? You only have to meet one of the tests. You don't have to meet all of the tests. So if Forco here is publicly traded, you just go through there and I clear Article 22 being publicly traded, not publicly traded here. So one other way I could do it is active business that's material in relation to the U.S. Company. What they don't want you to do here is say, oh, I got an active business and it's a hot dog stand or a food truck, right? Yeah, it's an active business, but it's got to be material relative to the U.S. and similar in scope to the U.S. So this would frustrate this, and you would get hit with the 30% withholding tax because we would gain Forco under the LOB and look to NRA for the treaty, and there's no treaty with NRA and our tax that we keep going. Okay, last one. The interposed corporation satisfies a derivative benefits test. An interposed corporation is entitled to treaty benefits when equivalent beneficiaries, defined term, own 95% of its shares. That's the stock ownership test. And non-equivalent beneficiaries do not receive deductible payments constituting 50% of gross income from the intermediary. This is very similar to that prior test a couple ago. So an equivalent beneficiary is a resident of a tax treaty country with the treaty withholding tax rates as favorable as those of the treaty at hand and an LOB provision. So again, they're saying, if you have significant shareholders above that would have been entitled to treaty benefits, interposing a corporation, you're not treaty shopping. You already had treaty benefits, okay? The rationale being that you're not doing anything that's inappropriate here. Let's knock out this example real quick, and I'll let you guys go. So, Sydney?
Italy Co.'s shares trade publicly on the Borsa Italian exchange. Italy Co. prefers to operate outside the European continent through a 100% owned holding company, Forco, in country F, which has a tax treaty with the United States similar to the model treaty. Forco does not make deductible payments to anyone outside of country F, and if Italy Co. directly owned U.S. sub, a dividend to Italy Co. would be entitled to a 5% withholding rate under the Italian-U.S. tax treaty. Therefore, Forco is entitled to derivative benefits under the country F U.S. tax treaty, such that a dividend from U.S. sub to Forco receives the preferential 5% withholding rate.
This is exactly similar fact pattern we talked about earlier. Italy already could avail of a 5% withholding tax coming out of the United States. It says here they like to invest outside of Italy via a foreign holding company. They're not doing that for